Powered by human research and AI insights, we deliver unmatched value. Stay tuned. For info only, not financial advice, you're with ChannelVest. This is your analysis. Get ready to dive deep into the best stocks for 2025. Buckle up, because we've got some seriously juicy insights coming your way.
What's fascinating here is that we're not just looking at individual companies, We're talking about the forces shaping the entire market. AI, cloud computing, the digital transformation. These megatrends will define the next decade, really.
Okay, let's unpack this. First up, Apple. iPhones, Macs, wearables, they're everywhere, right? But can Apple keep crushing it in 2025? What do the financials tell us?
Well, Apple's current price is hovering around $244.06 per share. They've got strong revenue growth, and that's not just because everyone wants the newest iPhone. Their services segment, which includes things like Apple Music and iCloud, is exploding.
Wow, so they're not just relying on hardware sales.
Exactly. And those services have higher profit margins, right? This makes them more resilient to economic downturns.
This is insane. Even with all the global supply chain issues, they've held steady.
Exactly. Analysts are loving their integrated ecosystem, how everything works together seamlessly, and their strategic move towards services. But stick around, because there are some risk factors to consider. You're with ChannelVest. This is your analysis.
Risk factors like what? Spill the tea.
Well, supply chain risks are still a big one. Then there's the heightened regulatory scrutiny, especially in the EU. And of course, you can't forget about the competition in the smartphone and wearable markets. Companies like Samsung and Google are constantly innovating.
You won't believe it, but next up is Microsoft. They've gone from software king to cloud powerhouse. They're basically printing money with their cloud services. It's mind-blowing.
Absolutely. Their cloud-first strategy is a total game changer. They're dominating the enterprise space with Azure, that's their cloud platform Office 365, and LinkedIn. They're playing the long game, building recurring revenue streams that are incredibly profitable.
Okay, strong cash flow, low debt. That all sounds amazing. But what are the experts saying about their stock, which is currently around $408.43 a share?
Reuters is pointing to continued earnings expansion. Ding, ding, ding.
That's what we like to hear.
But remember, even the mightiest can fall. The competition in the cloud space is getting fierce. Amazon Web Services is a major player, and Google Cloud is also gaining traction.
Ooh, competition makes things interesting. Don't forget to subscribe and leave your thoughts in the comments. We love hearing from you. All right, moving on to Amazon. It's not just about your next day delivery anymore. Amazon's reach is huge E. E-commerce, AWS, logistics, they're like an octopus with tentacles everywhere.
Their revenue growth is impressive, largely driven by AWS, and their ever-expanding online empire. But here's the thing. They reinvest so heavily that margins can be thin. They're constantly pouring money back into the business to fuel innovation and growth.
Hold up, so they're sacrificing short-term profits for long-term dominance. Is that a red flag?
It depends on your investment strategy. Some investors might see it as a sign of ambition and long-term vision. Others might be concerned about the lack of immediate returns.
Here's the crazy part. Even with increased competition, Amazon's market position is dominant. Analysts are super bullish on AWS's profitability and its potential to become even bigger than their e-commerce business.
That being said, margin pressure, regulatory concerns, and fierce competition are still factors to consider. Remember, you're with ChannelVest. This is your analysis.
Next up is Alphabet, the parent company of Google. Need I say more? Digital advertising, cloud, AI. They're basically taking over the world. But can they maintain this momentum in 2025? Stick around to find out.
They've got robust revenue growth, strong cash flow, and healthy margins. It's no surprise they're a market darling, with their stock currently trading around $185.23. But you know what they say? The bigger they are,
the harder they fall. You're not wrong. What are the potential pitfalls for Alphabet?
Well, for one, antitrust issues are a constant concern. For a company of this size, governments around the world are scrutinizing their dominance in search, advertising, and other markets.
But here's where it gets really interesting. Some analysts believe potential regulations might actually HLAP them by rebalancing competition. Who saw that coming?
It sounds counterintuitive, but it's a possibility. If regulations force Google to spin off some of its businesses, it could create new opportunities for smaller companies to compete. And that could actually lead to a more innovative and dynamic market overall. You're with ChannelVest. This is your analysis.
Wow, that's a fascinating perspective. Okay, now for something a little different. Nvidia, GPUs and AI chips. Sounds kind of boring. Until you realize they're fueling the entire tech revolution. Nvidia is on fire.
Their growth is explosive. Both in revenue and earnings, they have impressive margins and are constantly expanding their market share. And their stock, currently around $138.85, even saw a 180% surge in parts of 2024.
That's insane. No wonder investor sentiment is sky high. But what's driving this phenomenal growth?
Nvidia is perfectly positioned to capitalize on the AI boom. Their GPUs are the brains behind everything from self-driving cars to advanced robotics to the metaverse. And as AI becomes more pervasive, the demand for their chips is only going to increase.
So what you're saying is Nvidia is a BUY.
Well, hold on a second. Remember, high valuation brings risk. Plus, potential tech disruptions and the cyclical nature of the semiconductor industry could shake things up.
Ooh, a word of caution. Wise words indeed. You're with ChannelVest. This is your analysis. Don't forget to subscribe and let us know your thoughts in the comments. Up next, we have Tesla, electric vehicles, renewable energy, and Elon Musk. Tesla is a constant source of headlines, good and bad. But can they live up to the hype in 2025?
That's the billion-dollar question. Their revenue growth is rapid, but those margins can be a roller coaster. One minute they're soaring, the next they're plummeting, and capital reinvestment is huge as they expand production and chase innovation.
Volatility is the name of the game with Tesla, with their stock currently trading at about $355.84. But long-term returns have been impressive as they gobble up EV market share.
That's true. Tesla was the first mover in the EV space, and they've built a loyal following. But the competition from traditional automakers, any newcomers, is getting serious fence. Companies like Ford, GM, Volkswagen, and even Apple are all vying for a piece of the electric vehicle pie.
So is Tesla still a good bet? Stick around to find out. Let's move on to Meta platforms. From Facebook to the metaverse, Meta is betting big on the future. But is it paying off?
But their ad revenue is recovering nicely, free cash flow is improving, and they're restructuring to focus on new growth areas. Their stock is currently trading around $736.67, and some analysts believe they're undervalued given their massive user base and potential in the metaverse.
They've weathered some storms, but long-term growth looks strong as they adapt to a post-privacy regulation world. Smart move, Meta.
However, regulatory scrutiny, competition from up-and-coming platforms like TikTok, and the metaverse's huge capital requirements could throw a wrench in their plans.
Now for companies, it's a little more old school. Berkshire Hathaway, Warren Buffett's legendary conglomerate. This one's for the investors looking for stability and a proven track record. But is it still relevant in today's fast-paced market? What do you think?
They have steady earnings, low debt, and use a conservative capital allocation strategy. It trades at a very high absolute price, around $719,146, but that's a reflection of its strength and history of market-beating returns.
Analysts see it as a safe haven in turbulent times. Boring? Maybe. Effective? Absolutely. But what are the risks?
Well, succession planning is a definite concern. Warren Buffett isn't getting any younger, and there are questions about who will take the helm when he's gone. Plus, they're sensitive to economic cycles, and some argue they're overvalued.
Next up is Visa Cash. Yesterday, Visa is riding the wave of digital payments, and it's a smooth ride. But can they keep up the momentum in a world of rapidly evolving fintech? You're with ChannelVest. This is your analysis.
They boast high profit margins, robust earnings growth, and strong free cash flow generation. They're a financial machine, with their stock trading near $353.81.
Analysts predict further gains as digital payment adoption explodes globally. Visa's scalability and global reach are unbeatable. But what about the competition?
That's the key question. Fintech disruptors are emerging left and right, offering innovative payment solutions and challenging Visa's dominance. Companies like PayPal, Square, and Stripe are all vying for a piece of the pie.
So is Visa still a buy? Don't go anywhere. We'll be right back with the answer after a quick break.
Well, Visa has a strong moat around its business, you know. Their brand recognition, global network, and partnerships with banks and merchants, that gives them a significant competitive advantage. But they can't afford to rest on their laurels. They need to continue to innovate and adapt to the evolving payments landscape to stay ahead of the game.
Okay, last but not least, we have Johnson & Johnson. When it comes to healthcare, Johnson & Johnson is a household name. They're the epitome of a blue-chip stock. But with so much disruption in the healthcare industry, can they maintain their steady course?
They're known for steady revenue and dividend growth, low debt, and a defensive profile. They have a diversified business model, strong brands in pharmaceuticals, medical devices, and consumer health products. And their current price is around $156.15. This is the stock you want when the market gets rocky.
Analysts see J&J as a stable long-term play with consistent shareholder returns. It's all about resilience and peace of mind. But you know what they say, no investment is without risk.
Exactly. Potential litigation is always a concern for a company in the healthcare space, and healthcare regulations and pricing pressures on pharmaceuticals are ever-present risks.
So what does this all mean? We've covered a lot of ground, but are there any key takeaways you want to highlight for our listeners? You're with Channel Vestat. This is your analysis.
Absolutely. Connecting this to the bigger picture, it's clear that growth-focused investors should keep their eyes on those tech giants who are driving innovation in AI and cloud services. I'm talking about companies like Apple, Microsoft, Amazon, Alphabet, and Nvidia. They're the ones shaping the future.
They're the disruptors, the game changers. But you're also saying that diversification is key.
Exactly. You don't want to put all your eggs in one basket. Balance your portfolio with stable, defensive plays like Berkshire Hathaway, Visa, and Johnson & Johnson to weather any storm. You're with Channel Vest. This is your analysis. Don't forget to like and subscribe.
That's a great point. You got to have a mix of high growth, potential ND stability.
Right. And remember, risks are everywhere. Regulatory scrutiny, valuation pressures, and the global economy can change the game in an instant.
It's a wild world out there. But with the right knowledge, our listeners can navigate the market with confidence. You're with Channel Vest. This is your analysis.
Do your own research and make informed decisions.
And don't forget to hit that subscribe button and leave us a comment. We love hearing from you. We've talked about individual companies and their potential, but what about the bigger picture? How are these trends likely to play out in the coming years? What should investors be watching for on a macro level?
That's a great question. We've seen how AI, cloud computing, and digital payments are revolutionizing industries, right? But the real question is, how will these trends evolve and intersect? For example, will AI-driven fintech disrupt traditional payment systems like Visa? How will regulations catch up with the rapid pace of technological advancement? These are the questions that will shape the investment landscape for years to come.
Wow, that's some serious food for thought. So, for our listeners, I encourage you to dive deeper into these macro trends. Do your own research, stay informed, and, as always, happy investing.